everybody. And for today's video on growing your tree of prosperity, I'm going to spend a little bit of time to talk about core and satellite portfolios, what they are, how to think about it. And this is a term that might be bandied around by the financial institutions to seem more sophisticated than they really are. All right. So let's dive in to this concept. Right. So, what are core and satellite strategies? And this is a sophisticated concept used by the finance industry. It looks complicated in theory, but it can actually mean anything in practice. Okay, so it's useful for retail investors like you and me to understand this concept so that we can rein in the kind of risk, and contain the amount of risk that we can accept in our portfolios. Okay, so core and satellite, what does it mean? It means that you should be dividing your investments into two buckets. The core bucket is a set of investments that allow you to um, earn money by compounding over a long period of time. They are typically very stable. They have maximum diversification, and it should form 60 to 90% of your portfolio, depending on your risk appetite, right? So if you are the person that likes a lot of investing themes, you love AI, you love quantum computing, then your core portfolio should be 60% of your net worth, right? If you are one of those more stable kind of people and you don't really would like to chase these thematic investments, then 90% of your funds can be put into the core portfolio. All right. So generally, it is the stable core that allows you to fight inflation, that allows you to compound your wealth over time. Okay, core. Satellite. Satellite investments are your stock picks or your cryptocurrency bets that are designed to enhance returns, right? They're there to exploit and capture alpha, which is high investment returns above and beyond what's in the industry benchmark. And you also make satellite investments to exploit various opportunities. So they tend to be more thematic. Okay. And the satellite part of your portfolio does not have to dominate your portfolio. So typically you have about 10% to 40% of your investments in the satellite component of this arrangement. Okay. All right. So some characteristics of a core investment. Okay. Generally broad-based market exposure, low cost. Okay. They are passive and they are rules-based. So they're not very sophisticated. All right. But they are designed to track market beta, which means that they'll move up and down based on how the market moves up and down. There is minimum turnover and very high reliability in risk-adjusted returns. Okay, so that's core. For your satellite investments, we're looking at higher risk with a higher potential for return. There is active selection in the stocks, maybe those unit trusts where the fund manager gets to play with what stocks they're going to buy. It tends to be thematic, right? For example, betting on the aging population. It tends to be sectorial, like the AI or the IT sector. It tends to be factor-based, right? Maybe low price to earnings stocks, or it could be single stock positions, all right? And satellite portfolios are flexible, they're opportunistic, but they require a lot of monitoring and a lot of review, okay? So therein lies the difference between these two. And the typical instruments you will find for core portfolios would be things like global equity ETFs, investment grade bond ETFs, government bonds, high credit, AAA bond ETFs, or maybe regional broad market exchange traded funds, right? Like the STI ETF, if you have some Singapore exposure. So that's the core portfolio. For satellite portfolios, then it could be your single stocks with very strong fundamentals or catalysts. It could be ETFs focused on a specific sector, right? Like semiconductor, renewable energy. The latest one I got was quantum computing. Okay. It could also be small cap or emerging market positions, right? Your commodities, gold, your crypto, and your private debt, based on your risk appetite, all of them fall into the satellite portfolio. Okay. So now I'm going to share with you my opinion on this core satellite portfolio kind of arrangement. All right. And my first opinion is that you can DIY your core portfolio. All right. The finance industry charges 0.5 to 1% of your assets under management to build a portfolio. So if you are willing to develop that minimum know-how, you can make a core portfolio from various index ETFs that are traded in the local brokerages, right? The custodian brokers that grant you access to the New York Stock Exchange is where you can get, all your Vanguard kind of ETFs. You have access to London, you can get the UCITS kind of ETFs, right, that are tax advantage. Okay. What I'm showing here on the screen is a permanent portfolio consisting of global stocks, bonds, gold, and cash. What is known as a permanent portfolio. And you can tell that when you look at a correlation table like this, the numbers tend to be very low. And when the numbers are very low, it means that the instruments tend to be independent from each other. They don't tend to move together, right? So that way, the overall performance it's going to be better and you can sleep well at night. All right. Um, if you were to look at the statistics for the permanent portfolio over the past 10 years, the returns are nothing to shout at, 7.8%. But what is fantastic about this portfolio is that it doesn't move a lot. The annual standard deviation is about 6.66, which is about a third of equity markets. uh, we are talking about maximum drawdown of 13.36%. So if you time the market wrongly, you're talking about 13% loss, which is about one third that of even a well-built kind of real estate investment trust portfolio that we have in Singapore. Okay. And do note that I don't think there is a financial institution that can match a core portfolio that costs less than 0.4% every year, right, for you to build yourself. So if you build a core portfolio yourself, you're not likely to have an expense ratio higher than 0.4%. And that's something that no financial institution can match. All right. That's why I say that you should pick up a little bit of financial basics so that you can DIY your core portfolio. Build it, ignore it, and just put your salary into it. Let it accumulate at about 7 to 8% every year, and just enjoy yourself after that. All right. This is a very simple way to participate in capitalism. All right. So that's my first opinion. My second opinion is that satellite portfolios can be abused for people in the finance industry to earn commissions, right? Um, and you notice that these financial advisors, they love to cherry pick funds that are doing well at the moment to bait customers who are desiring outperformance, right? So what they do is that they just choose whatever fund that's doing well right now and say, you see, these people made 120% over the past 1 or 2 years. And then uh, because investors, they are not trained in finance, they FOMO, they buy into these investments, but future returns may not be the same as the past return. And the future return can be particularly bad if the standard deviation or the volatility is particularly high, right? And then you get stuck, you get stuck and your money is gone, right? So any single satellite investment strategy should be lower than 5% of your net worth, right? So if somebody wants to pitch to you a particular stock, right, a particular fund that is, for example, uh, for example, China consumer products, right? Okay, you should try to keep it within 5% of your net worth. Don't let it exceed that amount. Okay. But the problem is the way that it is sold, right? It might be sold like as if it is something that you can put in your core portfolio, right? Because it is not to the advantage of a commission salesperson to sell you something in a smaller denomination. All right. So be very, very careful. And these satellite portfolio components can be abused. All right. Now, the third point that I'm going to make is that whenever we see something that is a newfangled idea from financial institutions, we might want to ask ourselves the question, what is the opposite of that, right? So, value investors like to buy cheap stocks. Does it mean that the opposite of cheap stocks is expensive stocks, right? Who would be so stupid to buy stocks that are expensive? right? As it turns out, the opposite of a value investor is a growth investor. And these stocks seem expensive, but they're growing very quickly. That's why you're building a portfolio of growth stocks. So they are opposites to each other, right? So we can apply that same kind of mindset and discipline to ask ourselves, what's the opposite of core and satellite investing? Okay. And philosophically, the opposite of core and satellite investing is simply any form of investing that does not artificially build two silos to park your investments, right? Yeah, and one example is the investments that I subscribe to, dividends investing, right? In particular, we always consistently look for low volatility, high payout investments, right? We hunt for banks, real estate investment trusts, and anything in any sector that can generate income for us. Okay, and of course, we would try to balance out, for example, banks and REITs, so that when interest rates rise or fall, our portfolio is partially protected from changes in interest rates, right? Okay, so in my program, the dividend portfolio doesn't really have core and satellite components. They are basically about 15 to 20 local stocks. In fact, I have 60 local stocks that consistently generate income for me on an annual basis. Okay. And yeah, okay. But of course, mentally we can say that, well, within the dividends portfolio, there are certain core components like DBS, Fraser Centrepoint Trust, right? And then there are satellite components, and these satellite components can be ESR REIT, it can be Elite UK REIT, Hampshire, United Hampshire REIT. So these are high yielding but high risk kind of real estate investment trust instruments. So collectively, they are designed to give you about 5.5 to 6.5% every year. All right. Yeah. So that's just something that I like to share with the folks who follow this channel. Right. When someone offers you an idea, right, ask yourself, what is the opposite of that idea? Okay, what's so great about your idea, right? And when you buy something, there's obviously somebody selling the stock to you. Why is that person selling it? All right. Yeah, and that's something that is actually not taught in many advanced finance programs. Even the CFA doesn't teach people applying this mental model of inversion, right? Yeah, so I picked it up from Charlie Munger, right? So yeah, so it's something that you can think about. Okay, so how do we use this insight about core and satellite? All right, so first we understand the first principles of why we have core and satellite portfolios. Right, one is to beat inflation at a low risk. The other is to exploit the markets to get higher returns. Okay, so when designing a core portfolio, you want to focus on low cost. You want to focus on high diversification. Right, when someone pitches to you an investment, it is often a satellite holding, right? And satellite holdings, these investments, they are driven by narratives. You need to understand the story, assess how this outperformance can occur before you decide to buy it. And even if you buy it, a satellite holding should be by nature a very tiny part of your net worth, right? So if you like my content, you can subscribe to my channel. You can buy me a coffee here. If you want to listen to my life story, figure out how the financial independence and retire early movement works, then Google ERM intro and take the first link, and I will catch you on the next video. Thank you very much.